So, welcome back to the channel, everybody. And this video today will deal with the rules on business income in the OECD Model Convention. This is Article 7, and Article 7 contains a relatively simple rule for business profits. It says that enterprise profits can only be taxed in the country where the owner of the enterprise is resident, apart from the only exception, the only case where the enterprise has a permanent establishment in the other country. Now, usually at the place where the owner resides, there we have usually the headquarters of the enterprise. That is also a permanent establishment. And that leads below the line to the conclusion that profits of the enterprise will always be taxed there where the permanent establishment is located, where they belong to, either the headquarters or the branch in another country or what else. Well, how can we understand what that means in practice? Well, let's have a look. Imagine we have here factory A and factory B. Both have the same owner. It's a company which has the seat and place of management in country A. And now the OECD Model Convention in Article 7 says everything goes to the country of residence apart from the profit which has to do with factory, so the permanent establishment in country B. The remaining profit, that is what has to do with factory A, is taxable in the country of residence of the owner. So that's what 7.1 says. Okay. However, this, when we look a bit closer to that, that means now all the profits made by the permanent establishment, often abbreviated as PE, so all the profits which the PE in country B makes will be taxed in country B. It plays no role if the customers also are from country B. Every customer from which country the PE in country B gets or makes their profit with, no, forget about that sentence. That was completely nonsense. So it doesn't play a role where the customers are. Only the location of the PE plays a role. So the profit of country B factory can come from the customers in country B. That will be a frequent case, but it can also come from doing business with customers from country C. It can even come from doing business with customers from country A. The decisive and only important factor is this is the profit which was made by the permanent establishment in country B. So that can be taxed in country B. Now, that also means all the profit which is not connected to the permanent establishment in country B is automatically attributed to the country of residence, so to country A. So if you have business with customers in country B and it's done by the headquarters, this automatically can only be taxed in country A, so in the country of residence. So the decisive point is really who or which permanent establishment does the business transaction, does the job. So where the customers are located, that plays no role. Okay, now we should take into account, or we should register clearly in all our minds, that this permanent establishment principle is extremely fundamental for the taxation of enterprise profits. This is the one and only rule which everybody will always expect you to know when you say that you did something with international taxation in your studies or in your leisure time or so. So this Article 7 is extremely important, and it also is extremely important for you to understand the background. So you should try to understand why this principle has been established. So why nearly every fiscal administration of the world agrees with that permanent establishment principle. And then we will also have to talk about the question how one decides which profit is made by which permanent establishment. So how the profits can be attributed to the different PEs. So let's begin. The first conclusion or the first consequence of that permanent establishment principle is that when you look at it closely, it says simply everything which the enterprise does will be taxed in the country of residence, so at home. Only transactions exercised, executed, or however you call it, by the permanent establishment abroad will be taxed there. That means especially that selling goods or rendering services to customers in the other country, in country B, without acting through the PE in that country can only be taxed at home, so where you reside. Because that is seen as a part of the profit in the headquarters, so at home. You can just express that differently and say, in contrast to a direct investment where you set up a permanent establishment in the other country, a direct business transaction, a cross-border business transaction from your country to a customer abroad will never be taxed in the country of the customer. Where you have your business activity, where you do the job, there the things will be taxed. Direct transactions only, so rendering service, selling goods cross-border, that does not lead in itself to a tax liability in the other country. That is taxed at home. And the important question is now why? Why has this been established as a principle for international taxation of business profits? And as always in such situations, the answer to a complicated thing is simple. There is no other alternative. If you were to do it differently, the whole economy would not work anymore. Naturally, now that's a courageous allegation, so you will probably say why. So let's have a look to why. Imagine we do it differently. Imagine we abolish the permanent establishment principle and say, well, business transactions can also, from now on, be taxed in the country of the customer, even if you don't set up a permanent establishment there, or even if you don't make use of a permanent establishment in that country. So we had this situation, or we would have that situation here. A factory in country A sells product to a customer in country B. Let's say the product is a book. Okay, then we would not call it a factory anymore, but a publishing house. So sorry for the naive copying of that element on the slides, but imagine now we sell a book, €9, so rather a pocket book. Now, and imagine now we were obliged to pay taxes in the other country. What would we have to do? First, we would have to tell them the price we obtained for the book was €9. Then we need to declare the profit. So we would probably say from the €9, we have still to deduct the costs for printing and postage. So we end up with €6, and now we would be proud and declare that as a profit, and then we get the feedback, no, it's wrong. It's wrong because a huge amount of the expenses is still missing. If you want to be correct, we also have to deduct amounts for the depreciation. And, well, depreciation, that sounds so harmless. We would have to calculate the depreciation for all assets, buildings, machines, computers, everything which was involved in the production of the book. Historical cost, depreciation, useful life, all that. And there is perhaps also the one or other current expense, and it might be deductible or not deductible. For example, if we invited the author to dinner or to a restaurant and had some business talks there, then it's a question if that hospitality expense should be deductible or not. So if it should become a part of the deductible cost when we calculate the profit or not. We would have to review all these calculation items, because the trick here is if we have to hand in a tax declaration in a foreign country and calculate the profit, then we naturally would have to calculate the profit according to their rules. So when you think the machine has a useful life of 10 years, then the foreign administration would probably say, no, 10 years is too short. Please calculate on the basis of 15 years or so. So we would have to check and probably adjust all the items in our calculation which have to do with that single product. We have to review all the deductible and non-deductible expense invoices and documents and so on, if they can be upheld in the same way under the foreign law. Now, that makes big fun. Now imagine what would you in reality do if then a customer, let's say from far away, orders a book for €9. Probably the accounting department would give us a call and say no, under no circumstances. Because to work ourselves deeply into the foreign law in order to be able to fill out their tax declaration and clear up all the mess with all the questions which arrive with that foreign law, and learn the foreign language to understand their return forms, and all that is so expensive and so horrendous and so burdensome that we completely forbid you to deliver products to customers in that country. And the chaos would even become more if now a second customer orders the book, and the second customer is from country C, which has again a different legislation. So now we would have to compute the same thing under the now different legislation of country C. So we would have to calculate the depreciations again with the useful life, which is now accepted by the fisc of country C, with the percentages and depreciation methods which their law tolerates. We would have to debate all the provisions if we produce machines or so. For guarantee cases, again, we would have to think about the hospitality expense again and all that. So if you deviated from this permanent establishment principle and gave a right to tax direct cross-border transactions, all what happens in factory A would have to be constantly reconsidered under a different law every time when a customer shows up from a new country. So let's say in the year of 2022, factory A would be forced to have a tax accounting for everything which happens under the laws of country A, of country B, of country C, of country D, of country E. There are 200 countries in the world. So being an accountant there in factory A would be the direct road to madness. Every time you buy a new machine, you would have to inform yourself, how do I measure correctly the cost of acquisition of this single machine under the laws of all 200 relevant countries? Which useful life do I have to take for the tax computation in these countries, and so on. And this would be a complete mess. And this is why we have this permanent establishment principle. Because under that permanent establishment principle, you don't have this impossibility. You don't need to recalculate all that stuff. So, not necessary. Sorry, that was too quick. Under the permanent establishment principle, the rule is simple. Everything which happens in the headquarters, machines, buildings, hospitality expense, all that is booked and treated only under the rules of the country where you are resident. And everything which happens in the country of a permanent establishment, let's say in Far-Eastern, well, everything which happens in the offices, premises, and so there will be treated under the tax law of Far-Eastern. So you have to apply a foreign law, but only for the foreign part of the firm and only for under the laws of that single individual country, Far-Eastern. And now it's a reasonable assumption that if you set up a second factory or rent office rooms in a foreign state, that then you also have access to local tax advisors which can explain to you and help you with the tax law and other legislation of Far-Eastern. And then you only need for the staff and the office and so on, everything, you only need knowledge about the law of Far-Eastern for the PE in Far-Eastern. Again, not a chaotic mess of 200 different tax legislations which you have to observe. And this is the reason why the permanent establishment principle in Article 7 is fundamental and nobody is ever going to renounce on it. Now, the problem with that permanent establishment principle, that rule in Article 7, is, on the other hand, that it also opens a door for very favorable tax constructions, because the rule of 7.1 is already sufficient to understand how the fantastic tax-saving models of Google, Amazon, and similar enterprises on a global scale very often work. This is a core element, and it's relatively simple. Imagine you have to establish a firm. Let's take Ireland as an example. You have now customers in very different countries, and your business can be done by internet or mail. So you can send your product to a customer in country A, in country B, in country C, in country D, in every other country. And in all these cases, every profit you make from every individual taxation business transaction, Article 7.1 says, okay, it's only taxable in the country of residence because in all the other countries you do not have a permanent establishment. Now imagine why, for example, Ireland. Well, Ireland has a very low tax rate, or has had at least a very low tax rate, 12.5% for a long time. There have been rumors in the press that with regard to the planned global minimum taxation, they have declared to be willing to raise it to 15% in the long run. But it's still a very cheap country. Now imagine there were a cheaper country somewhere else, and you know it. Now before you set up your multinational or your globally operating enterprise, you would look to the map I would say, okay, instead of 12.5 in Ireland, I could obtain, let's say, 8% in faraway Eastern again. Then you would think, could I also establish my business without problems in faraway Eastern in an equal way? Well, for your business transactions, if you exercise them or fulfill your transactions by internet or mail, no problem. What you need is electricity, a stable political surroundings, and a few things more. So you could also establish your corporation in faraway Eastern and have your residence and headquarters there. And all the money would go to faraway Eastern at a lower tax level. And this explains already one of the major problems in a globalized economy. More and more transactions can be rendered cross-border. The distances have become smaller in real life. And so more and more it happens that the complete market in a certain sector can be served by a firm which is not present in that country, not even by a permanent establishment. And so, let's say books or so, you could supply all the demand which a country has from outside the country, which without paying a single euro taxes to that country under Article 7. And now the thing gets so, let's say, so impressive, because Article 7 here shows you, well, I'm losing all my money to a foreign country. And now, as we have seen before, well, to that Article 7 principle, there is no viable alternative. So that puts you strongly under pressure and makes you nervous if you are the fiscal ministry of a country. So you could even cleverly exploit that Article 7 rule, even if you are already established in a high-tax country. It's very, very simple. Let's imagine how it works. So let's assume we are company A and we have the historical mistake done a long time ago that we established ourselves in a high-tax country A, for example in Germany. Now our customers are all around the world, country A, B, C, D, E. And surprise, we can deliver our goods by mail or internet or in a way which does not require a permanent establishment. For example, if we are consultants, we can send our consultants by a train, by aircraft or so to the customers. They give advice there for 3 months or 3 weeks or how long ever it takes without ever setting up permanent establishment in that country. And so all the profits would be taxable at home. Now, we don't like to be at home where we are at home. So what can we do? One of the ideas would be, let's set up a second company in a country which pleases us more. Let's say in a low-tax country. And now, surprise, this business is now completely done by company B. So this, and so all the profits which we can obtain worldwide or in a certain geographical region completely go under Article 7 to company B, which is now located in a low-tax country. And later, when we need the money, we can think about paying it out in form of a dividend to the parent company. And there are two effects combined with that. First, for example, under German law, you would know there is a rule in paragraph 8b KStG which says most dividends which are paid from a subsidiary to a parent company are tax-free in the hands of the parent company. So we would pay a low tax in country B, and the low tax would be final. There would never come a substantial amount of money on top. So even if we bring the money home. The other alternative would be, there are countries where a dividend from subsidiary to a parent is strongly taxed, but then what you can do is just don't pay out dividends. Only pay them out as late as you can, so you can delay that part of the total tax burden for a very, very long time, perhaps even indefinitely. So this is naturally a very convincing and frequent tax saving model, which gets more and more attractive the more the world gets global, the more people make use of that. If your competitors do, you also need to do it. Well, this shows us, on the other hand, that we have huge tax saving possibilities under Article 7 due to the system which has been established here. In all cases where the place where the firm is established does not really matter for the possibility to carry out our business. For example, in my extreme example here, when you carry out your business by mail or by internet, it does not really matter where you are established. And so especially there, Article 7 gives to the enterprises a hidden option, a factual option. They can choose where they want to pay their taxes. They just need to establish their company in a country of residence which is positive for them and attractive for them under tax aspects. The only condition which is necessary so that Article 7 turns into a factual option or a hidden option for the enterprises is the condition that you must have the possibility to set up a subsidiary company in a foreign country. And this is nowadays, in contrast to the 1970s, where the first versions of the OECD model were published. No, not rather the final version. The earliest origins were far earlier, but that doesn't change anything. Originally, Article 7 was relatively risk-free or not so risky as today, because originally the possibility to set up subsidiary companies in other countries was rather theoretical. That was not so easily available as nowadays it is. But nowadays everybody can set up foreign subsidiaries, and so everybody can use Article 7 as a kind of a hidden option, giving him, her, or it, depending on man, woman, or company, giving them the choice where they want to pay their taxes if the location where they set up the enterprise does not really matter. Naturally, these two effects which you have seen then, if they give you a choice to choose a cheap country, they will worry the fiscal authorities of the globalized world considerably. So it cannot surprise you that the multilateral instrument, that MLI, which was signed and which plans to override the existing double taxation treaties of many countries with many rules against so-called tax abuse, that this MLI tried to improve the definition of a permanent establishment, so to make it a bit wider, to qualify more things as before as a permanent establishment, and also tried to find rules how a company which you as an entrepreneur here in this country set up in a foreign country in order to profit from their tax level, how the rights granted by the double taxation treaty can be denied in case that you just set up a foreign corporation with the major motive in the back of your mind to lower your tax burden. We have already heard in one of the earlier videos that there have been proposed additional clauses, that it is not sufficient to be resident in a country, but you also need to have the right owners. So limitation on benefits clauses, for example, or rules which say, okay, if if there is a suspicion that the existence of this corporation is mostly due to tax-saving reasons, then the applicability of the treaty for this company is restricted or even completely denied. So to deter you from exercising that hidden choice or hidden option, which Article 7 implicitly gives you, the signatory states of the MLI bring you strongly under fire and just kill the applicability of the double taxation treaty in a relatively wide extent in such cases. So a huge risk is created in order to avoid a very fundamental problem for the functioning of global taxation, the inbuilt hidden choice in Article 7. Yeah. Now, let's also come to another aspect. The relationship between Article 7 and other articles of the Double Taxation Treaty. You know, there is not only business profits, but dividends, interest, other article, license fees called royalties in the DTT, and so on. And now, naturally, an enterprise can also have that kind of income. And so the question arises, which of the two articles prevails, wins? Will a payment of royalties to somebody who runs a business be qualified and treated under business profit? Or will it be treated under the rules laid down in the article for license fees? The, let's say, general rule from which exceptions will be found is that the Article 7 rule prevails in a certain way over other articles. So to give you an example, what that means, we have a head office in country A, we have a permanent establishment in country B, so the simple structure which we showed already. Now we have a business partner in country A, and the business partner pays a license fee to us, but it pays the license fee to the permanent establishment in country B because, due to reasons which I don't like to explain now, the patent right, for example, for which we pay, is held in the permanent establishment of country B. For example, it has been developed there, and for historical reasons, it always has stayed there. So the license fee goes to the PE in country B. Under Article 12 OECD Model Convention, the license fee can only be taxed in the country of the recipient. The recipient is the firm, and the firm is resident in country A. However, Article 12.3 says if the license fee is paid over to a permanent establishment in the other country B, then that permanent establishment rule prevails. If the license fee is a part or becomes a part of the profit of the permanent establishment, the Article 7 says the country B is allowed to tax the complete profit of the permanent establishment. Article 12 does not exclude this, so Article 7 wins over Article 12 here because of the relation, the connection to the PE. Similar constellation, again the same thing, and now we have a subsidiary company in country A. Again, for historical reasons and for convincing reasons, the shares in company in the subsidiary company are held by the permanent establishment. So the dividend is paid over from the permanent establishment here to the from the subsidiary company here to the permanent establishment there. Okay. Now Article 10 would usually say that if a company in the one state pays a dividend to a recipient in the other state, blah blah, then certain limits apply. Here we would now find out, okay, this is not the case because the recipient is the company A and it's resident in country A, so a subsidiary from country A has a recipient of the dividend who resides in country A. This is not a cross-border case. So Articles 10.1 and 2 do not apply. Article 21 would come and happily say, this is my case. And Article 21 would also say, well, only country A can tax. So country B would be out under Article 21. However, the permanent establishment principle prevails and wins. Article 10.4 and 21.2, and the last one here really applies. 21 second paragraph says, in cases where the income in question has to do or ends up or belongs to a permanent establishment in another state, it can be taxed and it will be attributed to the permanent establishment in that other state. So the PE principle wins. The dividend can be taxed by country B as a part of the profit of country B, part of the profit of the permanent establishment. Perfect. There are even other constellations, for example, an inland constellation in country B, subsidiary in country B, and the shares are held by a permanent establishment in country B of the firm in A. So the dividend is paid from the subsidiary to the permanent establishment. Article 10.1 and 2 would now apply. The company in B pays a dividend to a recipient who resides in A. Here there would be a limit of 15 or 5% depending on how much shares you hold for the tax of country B, and the rest would go to country A. However, again, Article 10.4 says it is Article 7 which applies. This dividend is a part of the profit of the permanent establishment, and the profit of the permanent establishment can be taxed fully and without a limit in country B, so that dividend can be taxed by country B without a limit and full extent. So Article 7 wins. Such prevalence rules can often be found in the higher rank of Article 7 over other articles is underlined or mentioned in 10.4 for dividends, in 11.4 for interest, in 12.3 for license fees, and in 21.2 for other income. And I'm not sure that I have really found all of them. Might be that the one or other clause arises somewhere or in the future. The important thing is, when something ends up in the profit of a permanent establishment, that permanent establishment principle wins and gives the state of the permanent establishment the right to fully tax this amount. Now, there is something which might surprise you. In Article 7, you will find a rule about the prevalence of other articles, which now sounds like a vicious circle. Article 7.4 says, if the profits of the PE contain income which is discussed in other articles of the treaty, the rules laid down remain unaffected, so can still be applied. That sounds like a contradiction, because this sounds now as if the prevalence is exactly the other way around. So how can we solve that problem? Well, it's other cases which are meant here. And let me illustrate them. You have, again, let's simplify the case now. You have now a company in state A, and we have only the head office. And we have a subsidiary in country B. And now the subsidiary pays a dividend to company A. That dividend is naturally a part of all the business profits of company A. So Article 7 would say the dividend income can fully be taxed by company A in state A. And Article 7 would say, as this is a part of the business income, country B is completely out, because company A The recipient, the taxpayer, has no permanent establishment in country B. So the dividend could not be taxed in country B. That makes no real sense. And in order to avoid that result, where country B could take nothing on the dividends, there we have the 7.4 clause. In such a situation, State B is meant by the authors of the treaty to be able to keep a withholding tax. And in order to make that way free, 7.4 says, what Article 10 gives to country B is not revoked by Article 7 in this peculiar situation. So that's the case where 7.4 prevails. And the meaning is they want to exclude that country B loses every right to tax here. 7.4 so means a different constellation. You could even say as a thumb rule, to summarize the situation, in a conflict between Article 7 and other rules, there will always be that rule winning which gives to the source state of the income, so the non-resident state, the wider possibilities for taxation. Then you will probably always decide correctly. Okay. Well, now, due to the rule that the profits of each permanent establishment can only be taxed or can be taxed in the country where the permanent establishment is situated, you must be able to find out which profit was made by which permanent establishment, and that is the next task about which we have to talk. How can the profits of a PE be determined? The basic rule here is that the profit of the PE is that profit which has been caused by its activity. So you do not follow where the money is transferred to. You ask who has done the job. Sometimes you have a very clear situation. For example, if everything connected with the sale of a book, so the acquisition of the manuscript and the copyright from the author, keeping good relations with the author, printing the finished book, selling it, and sending it to the customer. If that all is done by the same permanent establishment, then the complete profit from the transaction will have to be regarded as profit of that PE. So imagine we have a seat and the place of management of the company in country A. We have a factory, so a permanent establishment in country B. Now we have a machine which is ordered by customer B and completely produced in country B and then sent to customer B. So everything is done by the PE in country B. Now, if our customer transfers the payment or pays to the bank account of company A in country A, that doesn't play a role. You don't ask where on which bank account the money ends up. You ask where the work was done. This was here completely in the permanent establishment in country B, so everything goes to country B. So profit is caused there, will be taxed there. A bit more interesting or problematic, depending on how you like problems or not, gets the situation if two parts of the firm cooperate. So let's imagine we have again the two permanent establishments, one factory or one headquarter and other stuff there at home. And we have a customer in B and a permanent establishment, a factory in B. Now, factory A acquires the job, the order, and factory B, sorry, there is a mistake, B builds the machine and delivers it completely. So here they do the job. The payment is again, for reasons of convenience, made to a bank account of country A. So what can we say about the job here, the work? The work here has been shared, evidently. The profit so belongs partly to permanent establishment in country A and partly to the one in country B. Now, which part belongs to which country? Well, here Article 7.2 says you should split up the profit according to the idea as if the two permanent establishments, the two parts of the enterprise involved, were completely independent enterprises. So that means the permanent establishment should get the price for the work which it has done, which an independent enterprise would have charged for the same work to the head office. That is often called the dealing at arm's length principle. That phrase with the arm's length principle just is a specific term for that two people do business with each other on a friendly but not too friendly basis, so that the distance between is a friendly one. The length of an arm, which is usually the distance which you keep to people which are friends but not closest friends or family members. Well, so the profit of the permanent establishment shall be calculated in a way as if the permanent establishment were a separate independent enterprise and the two were doing regular business with each other. So that is exactly the same rule which applies between a parent company and a subsidiary company, or between a company and its shareholders, behaving according to market conditions. In our example case, for example, oh my God, but you know what I want to say. In our example, the permanent establishment would demand a price, so you would have to attribute them a revenue for the work it has done. So the planning and construction of the machine, the delivery, the transport, the installation of the machine at the customer's place, all that work, all the economic benefit of that should go to them. Whereas the head office had also done a bit of work. For example, they had acquired the order. So that commission or that payment which an independent distribution agent would get for such a work, look for customers and bring them to us, that would be their part of the profit. And they have also done the bureaucratic work with collecting the money and doing the accounting. Also for that, they would have a right to a payment. So the revenue which results from the overall the transaction in total would have to be distributed between the two PEs, that we end up with everybody gets a share, a payment for his or her or its work. Well, as you see by the example, the decisive question to split up the profit between the two PEs is then usually who has done which work or which part of the work. And in order to find out which part of the enterprise is entitled to which part of the profit, you would have to look to the functions which the PEs in question exercise. So which work did you do? Because work demands remuneration. Then which assets have been used? Because if capital is needed to exercise an activity, then you will demand some remuneration for the capital, a kind of an interest, naturally. And there are also risks which are taken over by certain parts of the enterprise. Nothing is without a risk in the world, so unrelated parties would not take over risks for each other without getting paid in some way. Well, that could be by getting some enormous or less enormous chances for extraordinary profit in return, or a kind of a risk premium. But it's, I think, common sense that nobody takes over a risk without getting remunerated for that. And that is why, in practice, when an enterprise is required to determine which part of the enterprise has a right to which amount, why then people look to functions, capital, so assets and risks especially. In practice, this splitting up the profit between the headquarter and the permanent establishment is usually done in a kind of an auxiliary calculation. Your profit and loss calculation or statement for the whole enterprise just gives you the overall result. You don't need that for our specific question. To split that up, you would have to make an additional computation economically, which part of the profit and loss goes to which part of the enterprise. That is sometimes indeed called an auxiliary calculation or auxiliary and supplementary calculation. The German circulars or German guidelines from the German fiscal administration really call it a Hilfs- und Nebenrechnung, auxiliary and supplementary calculation, which they would demand in order to give additional information besides the overall profit and loss calculation of the enterprise for the whole world. Well, what you must naturally keep in mind is that the transactions about which we talk here do not really exist under civil law. They are entirely fictitious because there can be no transactions, there can be no contracts, only fictitious contracts, and can be no business relations, only fictitious ones. Because for a contract you need two persons, but a headquarter and its permanent establishment, they are both owned by the same person. So the manager of the headquarter and the manager of the permanent establishment, they are all only legal representatives of the same person. And, well, one and the same person cannot make a contract with himself, herself, itself. When you try to make a contract with yourself, you end probably up in a lunatic asylum. Because that's sheer madness. For a contract, you need at least two persons. So that is the difference between the situation of a parent company and a subsidiary company, or of a shareholder and a company. Between two persons, you can have genuine contracts. Here, you can only have fictitious transactions. Now, to define transfer prices for these business transactions as if the two parts of the enterprise were independent, different persons, just for tax purposes. That's sometimes an extremely different and a difficult matter, because you need to have good knowledge of the market relation or the market circumstances. And very often fiscal administrations can have different views about that. So when a quarrel comes up concerning the adequate, let's call them market prices for these fictitious business transactions between the different parts of the enterprises, then the question is, what can one do to reach a convincing result? The OECD, which has written the Model Convention, has taken several steps to make that transfer pricing thing working better. For example, they issue common guidelines on how transfer pricing should be done in the most relevant situations, publish them in order to give states a guideline how they should behave and deal with the transfer pricing, so that less conflicts arise between the views of different states. And now, very often also, if in a concrete situation a state thinks that the taxpayer's calculation is not correct, then they might correct the transfer prices, mostly by increasing the part which their part of the enterprise shall pay taxes on. And the OECD then says, okay, if the other state says, yes, the reasons for the adjustment taken by the other state are convincing, then they shall be applied to the counter correction. For example, just to make sure that the total profit distributed among both parts of the enterprise is in the end not more than the total profit really is. Imagine you have a total profit of 500 in the enterprise, and you distributed 200 to the one part, 300 to the other part. Now state A says, no, my part is 400. And the other state says, I still believe in your 300. Then you have total profit 500. State A claims 400 out of it. State B claims 300, in total 700. So you are taxed with in total more than what you earned. And that is why such a counter correction or counter adjustment makes sense. But as this only happens when the other state, or if the other state is convinced that the adjustment taken by state number one was correct, that mostly doesn't help, because no tax official will ever believe that money which was claimed by another state was claimed with good reasons. They will always hold a contradictory view, a different view, in order to save as much money which they can for their own state. And so very often it ends up in a conflicting situation. And also here, the OECD, no, not only the OECD, but also the international legislation provides us with several instruments to mitigate the problem. For example, there is a so-called mutual agreement procedure. The administrations can talk with each other in order to try to agree on a common point of view. If that is not successful, there is an arbitration convention between at least the EU member states on transfer pricing. So if a conflict arises, then the states can ask for an arbiter, a neutral person, or a neutral gremium, which after a certain while decides this is the solution and you have to stick to it. The same principle underlies the Dispute Resolution Directive of 2017 issued by the EU, which widens or extends that principle of a binding arbitration in cases of conflicting interpretation or application of double taxation treaty to all potential cases. And there are nowadays even more arbitration procedures proposed by the multilateral instrument. The multilateral instrument suggests that the signatory states should implement more and more arbitration procedures also within their double taxation treaty as a regular element of new double taxation treaties in the future, and they should also include it in existing old ones. Well, a last warning just here. When you have to deal with a problem where the let's say the calculation which part of the profit go to PE number one, which to PE number two, if that doesn't convince the fiscal administration and they correct it, then the consequences here are completely different from those which happen if the transfer pricing between a parent company and a subsidiary is attacked by the fisc. Because between two different companies, prices must be fixed in a contract and effectively paid. So something really happened. And if what was done was wrong, you can't correct what was done. So you have then a hidden profit distribution between the two enterprises, or a hidden capital contribution. More money was given to the parent, or more money was given to the subsidiary company as was needed, and so the only explanation for that will be a profit distribution or capital contribution. Both have tax consequences on top. Between a headquarter and a permanent establishment, the problem doesn't exist. No prices can effectively be paid because I cannot pay to myself something. I can bring some cash from the one hand to the other hand, but it's not a payment. Same owner of the money before and afterwards. So we don't have the risk that an over or underpayment has effectively been made. Here the only thing is if the transfer prices, which were underlying the auxiliary and supplementary calculation, which part of the profit belongs to which PE, was wrong, then the only consequence is the calculation is corrected. Nothing else has ever happened. This is a fundamental difference between the situation between two PEs belonging to the same juridical or natural person and the relationship between a parent and a subsidiary company or two sister companies. So, yeah, if we have here, for example, the permanent establishment A, factory A, takes over a machine from factory B. Here the machine comes. And then the managing director of this PE says, okay, let's pay a price to factory B for it, 20,000. And this price is later found to be too low by 10,000. Can that then be a hidden profit distribution? And the answer is no, it can't. Because we see that a machine has been given or moved better from the one PE to the other. But what we call a price is not a price. A price or even a payment is not possible between two parts of an enterprise which have the same owner. Money cannot change the owner, but that would be a payment, only that. So the payment is in reality non-existent. What we have seen here is 20,000 were taken from the bank account in country A and shifted to a bank account of the same person in country B. That's a withdrawal from the one PE without tax consequences and a contribution of cash into PEB, again without tax consequences. Both things are neutral with regard to the profit. The only thing you need to do here is to increase the revenue which was booked from as a result of the withdrawal from the machine from B by 10,000 to 30,000, and to adjust as a consequence of this the book value by which or with which the machine entered the A part of the enterprise. This book value and basis for future depreciations will then be 30,000. So here the price, if really money is moved, that's not necessary. It would even be strange. But if that happens, that's just an illusion. You can't pay for a machine to yourself. That's not possible. With two different companies, however, the situation is completely different. In such a case, we have a company A and a company B. A price must be fixed in a contract, and if that price has been too low or too high, then the difference is automatically a hidden profit distribution or a hidden capital contribution. In this case here, if B would have been a subsidiary of A, then the underpayment would have meant that 10,000 of value of the machine would have given to the parent company, the shareholder, for free. This is a hidden profit distribution with the additional tax consequence that a hidden profit distribution is a dividend and would trigger a withholding tax and require the application of Article 10 of a double taxation treaty and all the like. So some things are simple, some are complicated. Well, this was now an overview about the rule for business profits. Keep in mind the most basic rule is 7.1. Business profits can only be taxed in the country of residence, apart from the case where you have a permanent establishment in the other country, and then only the profits arising and connected with that permanent establishment can be taxed in the other country. All the rest is, at least for beginners, probably details. Thank you for listening and hope to see you again soon. Goodbye and till next time.